The Fed is about to crash the US economy, and it's even worse than many of us realized. You see, we just got the Fed minutes back, which gives us great detail and insight into what the Fed believes about the current state of the US economy, what their plan of action is going forward into 2023, and that has a huge effect on not only the future of the economy, but also on things like the stock market and the real estate market. So today we're going to break down exactly what the Fed had to say and why the future outlook for 2023 is not currently looking that great. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. And with that said, let's jump into it. We have just heard back in detail from the Fed of what their thoughts are on the current state of the US economy and what their plans are to do throughout 2023. Now, what I'm referring to is known as the Fed minutes, which is basically a detailed breakdown of what the Federal Reserve members have to say during their meeting. Now, this normally will get reported about 2 weeks after the fact, and it really gives us some great insight into what we can expect throughout the rest of the year. Well, it was just last March of 2022 when we saw the Fed shift gears from really bolstering up the economy, seeing things thriving, the housing market soaring, the stock market soaring, and next thing you know, around March of 2022, the Fed decides to start hiking interest rates, mainly for the sake of fighting inflation. The idea behind this is as you start to hike interest rates, it affects the borrowing costs for things like car payments, for things like credit cards, for things like personal loans, and things of that nature. And so it really starts to slow down consumer spending throughout the country, which in turn causes less demand for goods and services, and so it causes inflation to cool down as a result of that. Well, so far throughout 2022, we've seen the Federal Reserve hike interest rates at one of the fastest rates we've seen, with it going up already over 4.25% just since March of last year. Well, this puts us at the highest levels we've been at for interest rates in over 15 years, and to give you an idea of how it works, they don't just jack up the interest rates all at once. It's a gradual increase that takes place over a span of many months and sometimes years in that case. And so for us, what we've seen is an increase in March, increase in May, June, July, September, November, and December now is the latest rate increase. The idea behind this is to consistently keep monitoring information as it continues to come back to us so we don't go too fast causing an economic recession or too slow, not really making enough of a dent with inflation. Well, so far where we're currently at right now is we are seeing these rate hikes have an effect on consumer spending. It's starting to slow down on a nationwide level, but what it's not really having too much of an effect on yet is the labor market. The unemployment rate's still low at this point, and we're still getting hot jobs reports back, but let's take a minute to look at the main takeaways from the Fed minutes. Now, the first real takeaway I got from this was the Fed is really trying to get the best of both worlds. They're essentially looking for what's known as a soft landing, to where they can win the best of both worlds, where they get inflation taken care of and they avoid an economic recession all at the same time. They don't want to pivot too soon as far as their aggressive monetary policy, because that could lead to more problems with inflation. At the same time, they also don't want to stay aggressive for too long, because that in turn will cause an economic recession. But between these two problems, the Fed made it pretty clear that their number one concern is easing off of the pedal too soon. They don't want to take their foot off the gas as far as fighting inflation with their aggressive monetary policy, because their biggest concern is that inflation becomes a problem again. They even alluded to times in the past where easing off too soon was a big mistake, and obviously they're referring to times where Paul Volcker was the Fed chair and he was trying to fight inflation similar to what we're going through right now. He ended up taking his foot off the gas a little too soon, and inflation ended up becoming a problem all over again. So they're very keen on not making the same mistakes they made back in the 80s. So right now it's pretty clear that the Fed has a much more aggressive outlook on the future versus what the market has really priced in so far. You see, as we've been getting positive inflation reports back, there's been a lot of speculation, especially between investors and experts, that maybe the Fed might do an early U-turn. However, based on what we're hearing now, that really doesn't seem like a realistic scenario anymore, as the Fed seems very hawkish still at this point. In fact, they've made it pretty clear from the start, even months ago, where they've said that 2% inflation is their target goal. Now, I don't believe they're personally going to wait till it gets down to 2%, and they're even starting to take a step back from that stance themselves. They're even saying that once we start to get data coming back that reflects that we're definitely on our way to 2% levels, that's the point in which they may consider doing a pivot at that point. They also mentioned that that's probably going to take a long time for that to take place, which I also agree with too, because I think that they're probably going to be looking at a pivot between 3 to 4% inflation, which even that is going to be hard, and it's going to take a while to get to those levels, because as we get further down on the inflation ladder, it's going to get harder to get to that next level down. For instance, going from a 9% rate of inflation down to a 7% is easier than going from a 7% to a 5% and a 5% to a 3%. Another important thing to point out is the Fed mentioned you really don't want to look too closely into their slowing of the pace of their rate hikes. And this has been a big thing, is that many people like to really try to read between the lines, kind of get insight into what the Fed is doing. And they're saying, don't worry about it. We're planning on slowing down our rate hikes at this point, and that doesn't mean anything as far as change of plans for what we've said. Now, once their meeting was done, Jerome Powell actually said that despite the progress we've made on inflation, he only sees halting signs and expects rates to hold at higher levels even after the increases cease. So essentially, once they stop hiking interest rates, he plans to continue staying at those high levels for a decent amount of time. So overall, pretty hawkish stances here from Jerome Powell and the Federal Reserve members. And if that's not enough to convince you that a U-turn is probably not going to be happening in 2023, none of the Federal Reserve members whatsoever believe that a rate cut would take place throughout all of 2023. So naturally, as we got the Fed minutes back, we saw the stock market take a dip, as it really paints a gloomier outlook for the future of 2023 than the market already priced in. Now, just to add to that, we continue to get hot jobs report back, which in general normally would be good news, but in this situation, it's not good news, because the Fed ultimately wants to see that what they're doing with the rate hikes is working on slowing down the economy, not to the point of an economic crisis, but at least to the point where they're seeing things start to slow down. Well, that's not really happening at the moment, as we continue to see jobless claims come back lower than expected, as we're seeing the labor market in general prove to be very resilient to these rate hikes, and this really just gives the Federal Reserve more ammo as they're trying to maneuver this soft landing, believing that they can continue doing this and not cause this economic crisis. I personally do believe we will end up seeing an economic recession throughout 2023, but overall, the big picture I want to take away from here with the Fed minutes is that 2023 is going to be a very tough year. It's not going to be a year where we see the housing market or the stock market make a big turnaround. It's going to be rough. Now, as far as the next meeting goes, it's taking place in February 1st, and right now the expectations are we're going to see the Fed slow down the rate hikes once again, because in November, if you remember, they hiked interest rates another 0.75%, which happened 4 times in a row. Then we went down to 0.5% in December, and now we're expecting to see a 0.25% rate hike for February 1st. Regardless, I'm going to keep you up to date with the latest information, whether it's on the housing market, whether it's on the economy. And so with that said, if you enjoyed today's video and you gained some value from it, do me a favor and smash that like button. And if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, comment down below if you have any thoughts or questions. I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these 2 videos over here. And with that said, I'll see you on the next one.